Today we're doing a true and false quiz on mortgage forbearance. Question number 1. Forbearance equals forgiveness. This is false. Forbearance does not forgive your monthly payments. It simply delays them for a predetermined amount of time. Number 2. At the end of your forbearance period, you can choose how you want to pay back your missed payments. This varies. This depends on your mortgage servicer. Before entering into any forbearance agreement, you want to make sure you have a complete understanding of what will happen at the end of the forbearance period. Some servicers may require all missed payments to be due as a lump sum. Others may give you the option to pay back the missed payments over a set period. Or you may be given the option to apply for a loan modification. Number 3, your servicer has to work with you at the end of the forbearance period if you can't pay back your missed payments. This is false. At the end of the forbearance period, your servicer could require your entire missed payments due in full. If you cannot make that payment, your mortgage would become delinquent and the servicer can eventually begin foreclosure proceedings. Number 4, you can't be foreclosed on per the CARES Act. This is true and false. The CARES Act includes a temporary moratorium on foreclosures only through May 18, 2020. This moratorium only applies to servicers of federally backed mortgage loans. If your mortgage becomes delinquent during this time, your servicer can pursue a foreclosure once the moratorium ends. 5. Forbearance will save you money. This is false. Forbearance does not save you anything. It merely delays your payments. If your mortgage is $900 a month and you take a 6-month forbearance, at the end of that 6 months, you could owe a lump sum of $5,400 plus your next month's payment. Now, let's say your servicer allows you to split your missed payments over a 6-month period. That means that for the next 6 months after your forbearance ends, your $900 payment will now be $1,800 per month. If you forbear your payments for longer than 6 months, you can do the math to see how that would work out. Number 6, you can add your missed payments to the end of your mortgage by extending your loan. This one is a maybe. Your servicer may allow you to apply for a loan modification at the end of your forbearance period. At that point, you may need to provide proof of your financial difficulty, and your loan modification will have to be approved. If your loan modification is denied, you may be required to pay back your missed payments immediately as a lump sum. Or you may be given the option to spread the payments out on top of your regular mortgage payment over a set period of time, as discussed before. Number 7, a forbearance will not hurt your credit or your future chances at refinancing or purchasing another home. This is both true and false. It's true that as part of the CARES Act, servicers have been instructed not to report COVID-19 related forbearances as late or missed payments. But that does not mean that the forbearance will not show on your credit report. If you do a loan modification at the end of your forbearance, this most likely will show on your credit report. It may not hurt your credit score directly, but many loan programs will not allow a borrower to qualify for a new home loan or a refinance for 12 to 24 months after a loan modification. There is no law that says that individual lenders have to lend to someone who's taken advantage of a mortgage forbearance. And there's a chance that many lenders will not feel comfortable lending to someone who has used this option in the recent past. Number 8, forbearance is a last resort. This is true. If you are out of work or have had your income significantly reduced and do not have savings or unemployment wages to rely on, your options may be limited. We encourage you to reach out to your local and state government to see if there are any homeowner relief programs available. If you have no other options and must pursue forbearance, then we suggest taking the following steps. Number 1, contact your mortgage servicer directly. This is the company who you make your monthly mortgage payments to. You will need to arrange a forbearance directly with them. Wait times may be long, but you absolutely need to make arrangements with them before you become delinquent. Number 2, make sure you completely understand what happens at the end of the forbearance period. Request this in writing if you can. Will you need to make all payments immediately as a lump sum? Will you be able to split your missed payments over a set period of time? If they are offering a loan modification at the end of the forbearance, what documents will you need to supply? What is the loan modification process? Make sure you understand all of these details before entering into forbearance. Number 3, have a plan and a budget. As mentioned before, a forbearance is not forgiveness. Going into a forbearance, make sure that you have a plan for how you will pay your mortgage and any missed payments that may be due once the forbearance period ends.